Hello and welcome to Earnings Echo. We put together the most important information about CrowdStrike. We are talking about a $183 billion valuation here, plus, an architecture that is processing over 1 trillion events daily. So today we are doing a deep dive into the Q1 FY 2027 financial results to really uncover the core drivers behind these numbers and decode what exactly the market is pricing in right now. Let us skip the fluff, though. Did they actually beat the street's expectations? And how is the start moving right out of the gate?
Yeah, well, it was a comprehensive beat across the board. Like Q1 revenue hit $1.39 billion, which is up 26% year over year. And non-GAAP earnings per share came in at $1.10.
Right.
They exceeded every single guided metric,
Well,
actually. And because of this broad outperformance, management raised their full-year net new annual recurring revenue, or AR, growth guidance to 27.7% at the midpoint.
okay, that is significant.
Yeah, and additionally, they announced a 4-for-1 stock split. Obviously, splits do not change the underlying fundamentals, but making the shares optically cheaper really fueled immediate momentum in after-hours trading.
Okay, so the top line growth is clearly there, but I want to challenge the operational quality a bit because, well, anyone can grow revenue if they spend enough to get it. So what is powering the actual cash engine here? And crucially, is the hangover from that July 19th incident officially gone?
I mean, the data strongly suggests the July 19th crisis is totally in the rearview mirror. If you look at the net new ARR, it was a record $256 million, surging 32% year over year.
That is a massive jump.
Exactly. But to your point about the cache engine, it runs on just extreme efficiency. CrowdStrike uses this single lightweight agent architecture. So once their base software is on a customer's device, they can basically upsell additional security modules without any extra deployment costs.
Ah, right. So the infrastructure is already paid for, which means every new add-on sale is basically pure operating leverage.
Precisely. And that leverage is what drove a record operating cash flow of $591 million and $468 million in free cash flow.
Serious cash generation.
It really is. When you see non-GAAP subscription gross margins expanding to 81%, it just proves that incremental revenue is dropping almost straight to the bottom line.
Okay, let us scrutinize management's narrative versus the mathematical reality for a second. On the earnings call, the CEO framed this as a, quote, mythos moment where AI and cybersecurity collide. Grand words, right? But looking at a $183 billion market cap, isn't absolute perfection already baked into the stock? Walk us through the reverse discounted cash flow to see what the market expects at these levels.
Sure, well, a reverse DCF is not an exact science by any means, but it acts like a decoder ring for the stock price. So
Yeah.
normally analysts project future cash flows to find a fair price, right? But here we take the current price, let us use the pre-split $719.09.
Right, which gives an enterprise value of roughly $179 billion.
Exactly, and we work backward from there.
It is basically like looking at the final score of a basketball game and then working backward to calculate exactly how many three-pointers a team needs to hit in the second half just to win.
Exactly. So factoring in a 10% weighted average cost of capital, which is essentially the return investors demand for taking on the risk, and a 3% long-term terminal growth rate, the math gets interesting.
What does it imply?
It implies the market expects roughly a 22% compound annual growth rate in free cash flow over the next 10 years. So that places the stock at a premium valuation of about 130 times trailing 12 months free cash flow.
That is a steep premium. So connecting this directly to your portfolio out there, is a decade of 22% compounding free cash flow growth actually achievable to bank on?
Well, it is highly ambitious, for sure,
Yeah.
but the foundation is actually there. The mechanism making it possible is that CrowdStrike possesses the widest data moat in endpoint security.
Right, because AI models require massive high-quality data to even function.
Yeah, exactly. And by processing over 1 trillion events daily, CrowdStrike owns the foundational layer of security telemetry. I mean, they are not just protecting laptops anymore. They are aggressively expanding into identity, cloud security, and SIEM, which is security information and event management.
So by centralizing all of a company's threat data, they are continuously widening their total addressable market.
Exactly. They have the data and the margins.
But the expectations are sky high. Which leaves you with a final question to consider. If 10 years of flawless 22% growth is already priced into the stock, what margin of safety remains for your portfolio if frontier AI adoption faces unexpected macroeconomic speed bumps?
And finally, the obligatory disclaimer. All content in Earnings Echo is AI-generated information and does not constitute investment advice. Investing involves risks. We assume no liability for your investment decisions. Do your own research before taking action. Numbers checked. Portfolio prepped. Catch you again soon.